Market closely on the 31st anniversary of the 87 stock market crash. Whatever it is about October, it scares people. It's not technically the worst month of the year for stocks. That dignity or indignity belongs to September. But of course, our most noted market hiccups, disruptions, whatever you want to call it, have occurred in this month, and we've certainly seen enough of them already. And we're a little bit more than halfway through it. A Market Watcher's Alan Nuckman, John Tamny. Alan, from your vantage point, this market is certainly living up to October lore. But to step back from the wild swings, what is it about this month that doesn't?
I just think it's the last quarter of the year. People are getting, concerned about how the year's going to finish out. Maybe I don't know. 87. I was my first year of college, so I didn't feel the impact like some of the guys over my shoulder did. But the markets came right back. Let's talk about where we are right now. Stocks have stabilized. We're positive on the week in the S&P and the Dow. And looking at volatility, if you want to talk about fear, volatility is below that $20 pivot, which is the move that we saw from 11 up to 29. So it's pretty important right now. But if we're looking at things from a factual standpoint, you made a great point that September is really the shakeout. October just has a certain amount of nervousness going into the winter, I guess.
John Tamny, there's always concern, and I've reminded a lot of folks because you remind them as well, and you guys certainly know your stuff, that bull markets don't die of old age, but they can certainly be, assassinated by other developments. Now, I'm wondering if some of the other wild card issues, like Saudi Arabia, like China, maybe Italy and its budget, going kablooey and the Europeans walking away from them, any of that could disrupt all of this. What do you think?
Of course, it can't be stressed enough that the October correlation is entirely coincidental. If you go back to 1929, it was in October of 1929 that investors got word that President Hoover would sign the Smoot-Hawley tariff, a major tax on trade. Markets didn't wait for the signing. They corrected right there. In 1987, 31 years ago, James Baker gets on TV on October 18th and talks about he wants a much weaker dollar. Naturally, that led to a correction simply because investors are buying future dollar income streams. A weaker dollar was going to reduce their returns. And so you look this month, lots of jawboning about China, talk from the administration that it's going to limit foreign investment in 27 different sectors in the United States. You want to spook investors, have intervention in the investment process. These are surprises that led to corrections. It's not an October thing. We just seem to have surprises in this month.
Alan, we're following the Saudi Arabia situation right now and the impact on the oil markets, particularly right where you are right now. And it's been fairly muted. I mean, if there was a global panic building up because the Saudis might pull oil from us or pull oil, period, it's not evidencing itself. Now, maybe this latest report that it's shipping a lot of it to China, I don't know what's behind it, but it is counter what you would think would be happening, isn't it?
Right. It's another example of the markets not reflecting what you would expect. So right now, looking at crude, it traded between 65 and 70 for about 4 to 6 months, and then it broke up, went to 75. We come back to that 70 point. On a weekly basis, we're down about $1.50, so not any positive reaction, but I think it's reflecting this pause in the macro markets. To get back to China very quickly is another variable. If we look at the big picture, 2016, 2017, China's stock market went essentially straight up about 80%. So this pullback that we're seeing right now in the last 3 months, we're down 15% in China, is just a little bit of a correction of that overheated move. So I don't think there's been that much damage on China. And at some point, it's going to find some value if you look at some of those large cap China stocks as far as that opportunity goes.
John Tamny, it's maybe cliche to say that, markets over time richly reward you. We were showing earlier the beginning of this show, and I was covering the 87 market crash, that if you were to simply have stuck that out, you would have survived the 89 crash with the failed leverage buyout of UAO. You would have withstood the 9/11 issue. You would have stood the Asian the Asian market crisis, the Russian ruble crisis, even post the meltdown, the financial meltdown. You would have survived all of that had you just stuck to it. So what do you tell investors? I guess your time frame is crucial, but what do you say?
Well, what you tell investors is that the only constant about the United States is that we constantly progress. If you've got beautiful memories of the 1980s or 90s, if you went back to them right now, it would drive you nuts how primitive we lived back then relative to the present. We keep getting better, and so you can't let little mistakes, little errors in the near term cloud your vision that over time, Americans are incredibly productive, and because they are, the stock markets that reflect their productivity will continue to grow with hiccups in between.
Alan, is it your sense, and you talk to fellow investors and the people on whom you invest on behalf, that there's more skittishness now, that more want to get out now? I only say that because for some that can be a bullish indicator. What are you hearing?
It can be when the masses get nervous. Usually, you see the markets reverse. Now, what I saw yesterday was a financial flush out, not quite the move that I wanted to see, where it had a sharp decline and then we've seen it rebound and come back. So if we can see the S&P above 28.25, that's a halfway point of this drop from the top. Then that'll shake out the shorts and we'll make another move higher. One thing I do want to point out here is actually 70% of the time, rising rates correlate with rising stocks. So if you look at the last 60 years, there's been 13 periods of rising rates, and 9 of those times the stock market's moved up. So let's also remember that where we're coming from in the last years, the 10-year note made that extreme low in 2016, and we can both agree that the stock market's gone straight up as rates have risen. So I know that's a concern, but the market sometimes says otherwise.
Yeah, but I wonder if that math holds to if what you had before was a rise before the rising rates. You know what I mean?
Past performance is not indicative of future results, but I'm not
right.
concerned about the rising rates at this point until we get above 4% and people have a choice between putting the money in the stock market and getting a healthy yield in the 10-year note.
Gentlemen, thank you very, very much. Alan Uckman, John Tamny. Let's go to
Thank you.
Francesca Chambers right now, the Daily Mail, White House.